Let's look at the live tape for SoFi Technologies, trading on the NASDAQ under ticker SOFI. As of 11:23 a.m. Eastern Time, the stock is trading at $30.29, which is up a solid 2.07% for the day, or about 61 cents. The day's trading has seen a range between $29.33 and $30.45 on pretty significant volume of over 29 million shares. This is happening just days after the company reported what many are calling a blowout third-quarter earnings report. The immediate expectation, especially after seeing the headline numbers from that Q3 report last week, is that this stock should be decisively breaking out. We're talking record revenue, record member growth, and a big beat on both the top and bottom lines. So the question is, why is it fighting so hard to hold the $30 level instead of challenging its 52-week high of over $32? The reality of this stock's behavior is that its phenomenal quarterly execution is fighting against a much more complex and skeptical market narrative. The price action today isn't a simple celebration, it's a battlefield, and the stock is still trying to convince the market what it's truly worth. Let's establish the common ground. If you follow this company, you know the story. SoFi reported earnings 6 days ago, on October 28th. It was a clean sweep. Earnings per share came in at 11 cents, smashing the analyst consensus estimate, which was closer to 8 or 9 cents. Revenue was a record, climbing 38% year-over-year to over $950 million, also handily beating expectations. They added 905,000 new members, another record, bringing their total to 12.6 million. They also raised their guidance for the full year. On paper, this is a picture-perfect growth story firing on all cylinders. The expectation, which you can see all over social media forums and message boards, is that this was the final proof, the all-clear signal that SoFi has successfully transitioned into a profitable, high-growth powerhouse. But here is the deeper take, the reality that explains the resistance we're seeing on the chart. The market, it seems, has already read the press release and is now digging into the fine print. The big concern isn't the main lending business. That segment is performing incredibly well. The concern is the technology platform segment. This is the part of the business, which includes Galileo and Technisys, that was supposed to be the high-margin, scalable, pure tech growth engine. While that segment's revenue did grow 12% to $114.6 million, a critical metric, the number of total enabled accounts actually decreased by 1% year-over-year. This is the reality check. The market sees a 1% decrease in accounts for the tech part of a fintech company, and it gets nervous. Management emphasized that this is because they are moving up market, signing huge clients like Southwest Airlines and 2 other largest yet brands, which will provide more revenue per account. But the market is taking a show-me approach. Right now, that single data point suggests the tech growth story is slowing, making SoFi look less like a Silicon Valley software company and more like a very, very good digital bank. And that's the core of the problem: valuation. If SoFi is a tech company, its current price-to-earnings ratio of 55 and its high price-to-sales multiple might be justifiable. But if it's a bank, it's incredibly expensive. Other digital-first financials trade at PE ratios in the low double digits or high single digits. Analysts see this, which is why the consensus rating on the stock remains a hold even after that massive earnings beat. We saw UBS, for example, raise its price target but keep a neutral rating. The average analyst price target is sitting around $25, which is significantly below where the stock is trading right now. So the expectation is tech disruption, but the reality is that the financial world is placing a bank valuation on it, creating a ceiling that the stock is now pushing against. The intraday volatility we're seeing, this chop between $29 and $30.50, is the market trying to decide which story is correct. Now let's talk about the other major factor, putting a cap on the celebration: the short interest. This is something every SoFi investor needs to understand. There's a persistent narrative online that SoFi is a heavily manipulated stock, a prime target for a short squeeze. Let's look at the actual data. As of the most recent reporting period, SoFi has about 100.3 million shares held short. That's a lot of shares, but as a percentage of the float, it's about 8.47%. That's significant, but it's not the astronomical number you might see in a true squeeze setup. Here is the most important actionable part of this analysis, the part that separates hope from reality. To get a squeeze, you need shorts to be trapped. The two best metrics for this are the days to cover, DTC, and the cost to borrow, CTB. SoFi's DTC is currently around 1.13. This means that, given the stock's high average volume, all 100 million shorted shares could be bought back and covered in just over one trading day. This is a very low number. It means the shorts are not trapped at all. They can exit their positions with ease whenever they want, which means they are not in a panic and are not likely to be squeezed. Furthermore, the cost to borrow, the fee that short sellers have to pay to borrow the shares, is currently very low, sitting at around 0.35%. This is practically free. When a stock is hard to borrow and shorts are desperate, this rate can spike to 20%, 50%, or even 100%. A sub 1% borrow rate tells you that there is a very healthy supply of shares available to be shorted, and the institutions lending them are not concerned. So what's the short thesis? It's not a bet that SoFi will fail. It's a simple valuation bet. The short sellers are betting that SoFi is a great bank, but a terribly priced tech stock, and that its valuation will eventually come back to earth to align more closely with other financial institutions. As an investor, you need to know how to find this data. You can find short interest percent of float and days to cover on sites like NASDAQ or Fintel. You can find the cost to borrow on interactive broker platforms or specific data providers. When you hear talk of a squeeze, checking those two metrics, DTC and CTB, is your reality check. High DTC and high CTB means pressure. Low DTC and low CTB, like SoFi has now, means it's just normal market positioning. What's your take on the short data? Do you think the low borrow rate means the short thesis is weak, or that they just aren't scared? So if the tech platform is a question mark and the valuation is stretched, what's driving the 2% gain today? The lending segment. That part of the business is frankly beautiful. Student loan originations were up 35% year over year, and home loan originations were up 93%. This is SoFi's engine. The end of the student loan moratorium was the catalyst everyone waited for, and SoFi is clearly capitalizing on it. They're also managing risk well, with charge-offs at their lowest level in 2 years. This is what's keeping the bulls in the game. The company's bank charter is allowing it to gather deposits and manage its net interest margin effectively, even in this high-rate environment. The company itself is essentially 3 businesses: the lending segment, which is its bread and butter, the financial services segment, which is the one-stop shop app with SoFi Money, Invest, and credit cards designed to acquire members cheaply, and the technology platform, the B2B segment with Galileo, which is supposed to be the secret weapon. The entire bull-bear debate for the next year will center on that tech platform. The expectation is that those new large clients like Southwest Airlines will be fully ramped up by 2026 and send revenue and accounts soaring. The risk, the reality, is that if those clients are slow to ramp up, or if the 1% decrease in accounts becomes a trend, the market will permanently re-rate SoFi as just a bank. Looking forward, the catalysts are clear. First, any new announcements about major brand partnerships for Galileo will be huge. Second, the next few earnings reports must show a re-acceleration in tech platform account growth. Third, any pivot by the Federal Reserve toward cutting interest rates would be a massive tailwind for SoFi, as it would lower their cost of funds and likely spur more demand for loans. The risks are the opposite. A recession that hits the credit quality of their personal loan book is the #1 danger. The second danger is that Galileo's growth continues to stagnate, proving the short seller's valuation thesis correct. Comment below with the segment you think is more important for SoFi's future, the high-growth lending business or the high-margin technology platform. Ultimately, we are watching a company with near-flawless execution that is running headfirst into a wall of skeptical valuation. The expectation, fueled by a passionate retail investor base and strong member growth, is that this is the next great financial disruptor. The reality is that it is a high-performing digital bank that the market is refusing to grant a full-fledged tech multiple, especially while its tech segment is showing signs of slowing. The path forward for the stock is not about a short squeeze or social media hype. It's about proving, quarter after quarter, that its technology platform is a genuine growth engine, not just an accessory to its lending business.